Welcome to the deep dive. If you need to understand the tectonic plates shifting beneath the world's fastest moving capital markets, you've come to the right place.
Absolutely. We don't just skim the headlines.
No, we take these complex regulatory filings, we slice them open, and, we really try to extract the high-value insights you need.
And right now, market activity isn't just about more trading volume. It's about a fundamental structural change happening.
Right.
And to really grasp that, you have to look at the exchanges themselves, at their metrics, their strategies.
So that's our mission today. We're focusing on BSE Ltd. We have their unaudited financials for the half year that ended September 30, 2025.
That's H1 FY26.
Exactly. And we also have their investor presentation, which adds a lot of color. These docs were all approved on November 11th.
Our goal for you is, I think, fourfold.
Mm.
First, to just synthesize the sheer magnitude of the financial growth.
And it's massive.
It really is. Second, to pinpoint the single business segment that is. I mean, it's just reshaping their entire revenue mix.
And third, we need to look at the stable, high-volume business that supports everything.
And finally, and this is maybe the most interesting part, to really grasp the huge corporate reorganization that's happening behind the scenes.
The scale is immense, but the growth rates they're even more incredible. So let's start with that big picture, the consolidated results.
H1 FY26 versus H1 FY25.
Right. Let's start at the top line. Revenue from operations. What are we looking at?
Well, it was a monumental shift. Consolidated revenue from operations went from about 1,34,000 lakhs
In the first half of last year?
to over 2,000 lakhs in H1 of this fiscal year.
Okay, so for anyone trying to do the math, what kind of jump is that?
That's a surge of just over 51% in 12 months. This isn't just, simple expansion. This is rapid market dominance.
A 51% revenue jump is phenomenal. But that doesn't mean anything if your costs grew faster.
Yeah.
Did they actually manage to translate that into profit?
They didn't just translate it, they amplified it. This is where you see the operational leverage really kick in. Consolidated net profit after tax from their continuing operations. It shot up from 60,689 lakhs
In H1 FY25.
to 108,324 lakhs in H1 FY26. We're talking about nearly doubling the net profit.
Doubling the profit. So a 51% revenue increase leads to a nearly 100% profit increase. That tells a story of huge efficiency gains, doesn't it?
Absolutely. And you see it clearest in the operating margins.
Right, the EBITDA margin.
Exactly. The operating EBITDA margin saw a huge improvement. It went from 50% in H1 of last year to a commanding 65% in H1 this year.
And in the documents, they're careful to specify that this is excluding core SGF.
Yes.
For our listeners, why is it so important to exclude the core settlement guarantee fund when you're looking at that margin?
That's a really crucial clarification. The SGF, it's restricted capital. It's money that's set aside to ensure market safety, to settle trades if someone defaults.
So it's not their operational cash.
Not at all. It's not deployable. It's not profit generating. So by excluding it, that 65% figure gives us a much cleaner, truer picture of their core business profitability.
How efficiently they're turning fees into income.
Precisely. And that jump to 65% tells you their fixed costs for tech and compliance are now largely absorbed. Every new transaction they process drops much more heavily to the bottom line.
And we have to look at the per-share data, which was restated because of a major corporate action.
Yes, and we will get to that.
Yeah.
The consolidated earnings per share, or EPS, for continuing operations after you adjust for the bonus issue, climbed from 14.7 to 26.36. That's the investor's view of that profit doubling.
And just quickly, before we move into the engine room, what's the balance sheet health look like?
Undeniably strong. The consolidated net worth is at over 5,21,000 lakhs as of September 30th.
That's a huge increase in just 6 months.
It is, nearly 18%. That provides a really significant capital cushion and financial stability.
Okay, those are the headline financials. Now for the why. Where is this all coming from? We know for exchanges, transaction charges are the main driver, and one segment is the undeniable star here.
Equity derivatives.
That's it.
This is that seismic shift we mentioned at the top. Derivatives are now the primary engine of growth. The numbers in the investor presentation, they just illustrate an exponential adoption curve.
So give us the headline figure, the derivative turnover.
We're looking at average daily premium turnover, or AD premium 2. In the second quarter of this fiscal year, it hit a stunning 1,50,045 million.
Wait, say that again? 150,000 million.
Basically,
That's staggering. But for context, what was that number doing just say 18 months ago?
back in Q1 of FY24,
Yeah,
it was a minuscule 468 million.
468 million.
Yes, think about that. The transaction activity has grown over 320 times in a year and a half. This isn't just market growth, it's a product launch that has redefined their entire ecosystem.
And with that much premium turnover, you have to consider the underlying risk. What's the notional turnover telling?
That's the key, right? The average daily notional turnover in Q2 was 8.7 trillion.
8.7 trillion.
And you really need to understand this. The notional value is the theoretical value of all the contracts being cleared. That number shows the monumental risk exposure the market is handling every single day.
Which shines a spotlight on the importance of the clearinghouse, ICCL.
Absolutely. For maintaining stability.
And this success isn't just a domestic story. They're looking to export this product.
They are. The documents note a strategic plan to make Sensex futures and options available for trading at India INX.
Their international arm in Gift City.
Right. Starting Monday, February 3, 2025, they're leveraging this incredible domestic success to capture offshore volume and build international relevance.
So while derivatives are giving them this explosive growth and these huge margins, the classic equity cash segment is still vital.
It is. It's the foundation. The average daily turnover in the equity cash segment was a solid 75,837 million in the first half.
You need that stable cash market for the derivatives to trade against.
You do. And it all sits on this tremendous underlying scale of the Indian market.
Right.
You can't forget the ecosystem size. We're talking over 223 million registered investors now.
And the total market cap.
A staggering $5.27 trillion. This whole growth story is tied to rising financial participation and just a structurally larger economy.
Okay, so if derivatives are the flash flood of transaction revenue, where's the steady river? The high volume, predictable, recurring revenue.
That would be the Star Mutual Fund platform.
The silent powerhouse.
That's a perfect way to put it. It generates revenue through sheer volume and reach, so it's less susceptible to the daily market swings that you see with derivatives.
What kind of volume are we actually talking about?
In H1 FY26 alone, the platform processed 384 million orders.
384 million. That's an operational achievement in itself.
It really demonstrates the robustness of their tech stack.
And financially, what did that volume translate to for the half year?
The mutual fund revenue came in at 1,310 million. That's a healthy increase from about 1,067 million the year before. So they're successfully monetizing that volume.
What stands out to me is the sheer infrastructure needed to move that kind of volume. This isn't just a website.
No, it's a massive national distribution network. They have 256 million registered investors on the platform.
Okay.
And crucially, they're powered by over 81,000 distributors spread across more than 700 cities. That physical and digital footprint is just unparalleled.
And we should probably just briefly mention the stability from their ancillary corporate service.
Right, the services to corporate segment. This is mostly listing fees. It brought in about 1,851 million in H1. It's reliable income. It acts as a ballast.
Okay, so we've covered the financials, the market drivers. Now let's move from performance to intent. The strategic moves the board initiated are arguably the most important long-term takeaway here.
The structural reordering is fascinating. It points to a future that's heavily reliant on a unified technology platform.
But first, the bonus issue. Let's just quickly cover that.
Right. They allotted 2 bonus shares for every 1 share held.
Which is why all those EPS figures we mentioned had to be restated.
Exactly. The record date was May 23, 2025. It's a classic move to increase liquidity and market access to the stock.
And then there was a divestment. They sold off a subsidiary.
Yes, they divested BSE Ltd, or BIL, and this wasn't a fire sale of a struggling asset. It was profitable.
Right.
It generated a profit on the sale of about 1,440 lakhs on a consolidated basis. It's a clear move to focus their resources purely on core exchange and technology services.
And that brings us to the most strategically important move. The planned merger of 3 subsidiaries into one single technology entity. This is the definition of a structural shift.
This really signals their priority. They've initiated a merger of BSE Investments and BSE Administration and Supervision
So the investment arm and the admin arm.
are merging with BSE Technologies Private Limited. And BTPL, the technology company, is the surviving entity.
So why merge the administration and investment wings into the technology arm? That seems to be the key insight here.
I think the strategic implication is a complete centralization of the support infrastructure.
Everything under one roof.
The investment function, the regulatory administration, and the core tech platform, all under one roof. It streamlines operations, it unifies IT systems, and it makes oversight potentially much easier.
And when you have that kind of explosive growth in a high-risk area like derivatives?
Exactly. 320 times growth. Unifying your admin and tech platforms isn't just about efficiency. It's a critical risk management move. It's designed to handle that scale.
So the company is betting its future on a single, bulletproof, highly scalable tech platform that integrates all functions.
Precisely. It simplifies compliance, and it lets them execute market innovation much faster, because they know the administrative and investment support is instantly aligned with the tech pipeline. This consolidation is a direct response to those massive volume increases we just discussed.
Let's pull the lens out a bit then and look at the entire integrated ecosystem these results reflect.
The group's structure is really layered. You have the Indian Clearing Corporation, ICCL, which is essential for managing that $8.7 trillion in notional turnover.
A risk management piece.
Yes. And then you have BSE Index Services, BISPL, which manages over 180 indices, including the Sensex.
And the index services arm has been a recent focus for them, right?
It has. BISPL became a wholly owned subsidiary back in June 2024. And this vertical integration paid off immediately. They've seen an 80% increase in revenue from their core index operations since the takeover.
So owning and monetizing your own data and intellectual property.
It's a hallmark of a modern, successful exchange group.
Okay, finally, let's just circle back to that global footprint via India INX in Gift City.
India INX is their international hedge. Through its subsidiary, India INX Global Access, they offer clients access to over 135 global exchanges. They're making sure they have a platform ready to capture international flow.
And the numbers show it's gaining traction.
It is. It's not the main growth driver yet, but it's strategically vital. If you look at the snapshot for September 2025, they had activity from 840 companies, 25,000 trades, valued at $399 million.
It's a solid foundation for future expansion.
Exactly.
This has been a really revealing deep dive. We've seen a market totally transformed by derivatives, leading to profits almost doubling and operating margins hitting that incredible 65% mark.
Right.
And crucially, we see the company responding to the scale by fundamentally reorganizing, by divesting non-core assets and merging key functions directly into their technology platform.
I think the core takeaway is clear. The success of their product innovation, specifically in the derivative segment, directly funded and then necessitated this strategic consolidation. That high profitability is being channeled straight into building a more efficient, unified, and risk-aware tech ecosystem.
Which leaves us with a central question for you to consider. Given this strategic decision to merge the administrative and investment wings directly into the technology subsidiary, how will the exchange balance continued aggressive innovation and market expansion, which demands speed, with the critical need for unified risk oversight and security?
Especially when you're handling $8.7 trillion in notional turnover every day.
Exactly.
Well, they rely heavily on the AAA credit ratings of ICCL and strict ISO certifications to build confidence. But integrating disparate administrative functions into a singular, rapidly scaling tech platform introduces new complexity. I think their next major operational hurdle won't be about generating volume, but about managing the operational risk and the security demands that are introduced by that spectacular speed and scale.
That is the ultimate balancing act in a rapidly evolving market. Thanks for joining us for this deep dive into the financials and strategy of one of the world's most interesting exchanges. We'll see you next time.